country responded to the crisis by great lockdown strategy. Unlike South Korea responded to the crisis by doing an aggressive testing, and they enhanced their public health infrastructure and service provisioning. They controlled the pandemic, and the economy is back to the normal stage. But given the nature, given the structure, how our country responded to the crisis was through a great lockdown strategy. But lockdown means economic distortions or economic disruptions will be enormous. And the recovery will depend on the effectiveness of our public health infrastructure, our public health preparedness, and that trajectory. Because we economists or you, the legal experts, we cannot take any decisions in vacuum or in isolation, because this is basically a human tragedy and it relates to the health crisis. So we need to work with public health experts and deal with this crisis, because we cannot deal with this pandemic in isolation. So, you have seen the IMF growth projections, and growth, it's going to be on the negative quadrant by -3 points. That's what the drag of this pandemic on the global growth projected by the IMF team. And here, what is very relevant is the policy coordination to deal with this imminent crisis. And of course, my topic of conversation is monetary, but unless we have the policy coordination with the fiscal and also the labor market, then we won't be sufficient to deal with this pandemic, because we need to see all the possible economic policy channels in which this pandemic can be dealt with and how to mitigate this crisis. And given the enormity of this economic contraction we face now, how to trigger the structural transformation essentially depends on how we plan our policies in coordination, the macro policy in coordination. This requires monetary and fiscal policy coordination and also the labor market reforms. And let me tell you how Isabel yesterday put it in her, that talk. As I mentioned, Isabel is a member of the European Central Bank. So she mentioned that the crucial variable here is the potential output. And, to measure the potential output, what is the potential output of our country, or you can relate to you that what is your potential? It's an unobserved variable. So even in normal times, it's very difficult to measure the potential output or even the economic slack. So right now, given the high uncertain situation, how to arrive at this potential output is very crucial. And I don't know whether legal students don't get intimidated by the economic models and all. We do certain models in which we arrive at some conclusions based on the coefficients. So what we do in our country to reach the measurement of the potential output is we use the econometric methodology. We use some filters. In layman terms, what a filter does is for any macroeconomic series, you have two components. One is the overall trend component, the other is cyclicality. So what we do is we take out the cyclicality and we call this trend as potential. But potential is, of course, an envelope concept, but that's the way we arrive at our potential output. And this is very relevant to measure in the context of pandemic, and the assumptions and the methodology and the challenges to achieve this potential output is quite different than how we measure our potential output in the normal times. So in the medium to long term, the impact of this pandemic on the potential output, on the inflation, it's very crucial to analyze, and that depends on how the firms, the household, and the policymakers respond to these challenges. And in the short term, the potential output will be affected by the disruptions in the global value chains and the social distancing measures we follow during the great lockdown because all these things constrain the full use of capital and labor. And you look at the certain sectors of the economy, this impact is even irreversible because we may not be even returned to the previous size. The livelihood crisis, we have seen the exodus of the migrant crisis. This is enormous. Job loss, this is enormous. So to deal with this pandemic, focusing just on the monetary policy, we may miss the bus. That's why I emphasized on the policy coordination, fiscal, monetary, and the labor market coordination. And labor market institutions, they're very vital for the structural transformation, because the way we have the labor markets in India, they are highly fragmented, they are highly segmented, and that complicates the conduct of the monetary policy and fiscal policy. And also we need to see our economic diplomacy, because there are risks which is coming from the protectionist waves that's happening globally, because that could reverse the current pattern of our prediction or the international prediction. So that those risks which is coming from the the protectionist wave that's happening between US, China, and in other parts of the world, that also affects the way in which our policy respond to. And of course, internally, if you look at the major challenge is the financial distress the firms and the household face. And on the top of that, we have to deal with the non-performing assets. So it's a very complicated scenario in which we need to float our monetary policy. And how India as a country responded to the COVID pandemic, let's unpack the monetary policy package. On March 27th, Reserve Bank of India governor reduced the repo rate and the reverse repo rate. The repo rate was reduced by 75 basis points and the reverse repo was reduced by 90 basis points. And basically, to infuse liquidity into the system, the reforms were announced, like we need to infuse the liquidity to the tune of 3.7 trillion rupees. And that is coming around 1.8% of GDP. And we also announced that the cash reserve ratio to be cut by 100 basis points. Then we increased the marginal standing facility to 3% of the statutory liquidity ratio. So it's like basically we are dealing with the policy rates and the policy corridor. And even before this, in early February, that the cash reserve ratio was exempted for all the retail loans to ease the funding cost. So basically, it is to nudge the banking sector to go for investment, to go for the credit facilities, rather than parking their funds with the RBI. It's basically nudging the behavior of the banking sector. And also, we announced a 3 month to 6 months moratorium on the loan repayments. This is also to basically to give an ease in the crisis times and also to infuse the liquidity in the hands of the people. And if you remember, on April 1st, RBI created a facility to help the subnational governments. And we announced the ways and means advances to the subnational governments to increase by 60%. And it was 30% earlier. So this gives a kind of flexibility or a fiscal space to the subnational governments to deal with the pandemic, because it's not only the central government that deal with the pandemic, the subnational governments, if you look at constitutionally, you know it better than me, the legally, the constitutional assignment public health, public order are within the domain of states. But if you look at the international migration, or interstate migration, the interstate quarantine, all these things are the functions of center government. But in spite of that, the states are doing the heavy lifting. So the fund transfer or the improvement in their fiscal space is very relevant, and how the monetary policy can respond to this. So that's how they increase the ways and means advances. In a way, it's a kind of monetization of deficit. I will be coming to this point later. It's a kind of, let me tell you the other announcements what we have gone through. And the government announced many measures targeting the business. Like we had this collateral-free lending program with 100% guarantee. We have subordinate debt for the stressed MSME with partial guarantee. So basically, the criticism we faced is that we were infusing liquidity into the system and we were providing basic guarantee rather than focusing on a kind of fiscal stimulus or a kind of fiscal policy package which was required to trigger the economy. So that's the way it was. Like as I mentioned earlier, there could be a firefighting package, there could be an emergency package, and there could be a long-term reforms package. So how India responded was more or less, it's like a long-term reforms-oriented package. And regarding the firefighting package, what we were focusing on is we were focusing on infusing the liquidity and also basically guaranteeing the system. So that criticism is there, and in the question answer session, we can debate over that. Like the question number one, whether monetary policy stance is effective to deal with this pandemic, if you compare it with a fiscal policy. Two, whatever policy we designed, that was an emergency package or was it a business as usual package? So this can be debated. But of course, decreasing the repo rate or the decreasing the policy rate is very important, because the assumption is that if you decrease the policy rate, it can trigger the economic growth. But we have seen that this is not one-to-one, like the monetary policy announcements by decreasing the, repo rate can immediately trigger the economy, because we have a lot of infrastructure bottlenecks. There are a lot of other structural factors which we need to deal with. So in the context of an emerging economy like India, can monetary policy be everything to respond to a crisis? This is a question. But in next economic and political weekly, the students may be interested. My co-authored paper with Abhishek Anand. He's in Harvard Kennedy School. So we have written a paper on impact of the negative interest rate policy in the context of the emerging Asian markets. You can take a look at that. It will be up this Saturday. In that paper, we were asking this question, like how the central bank implementing the negative interest rate policy to boost the domestic economy, and such policies, do they have unintended consequences, especially in the context of emerging Asian markets? That was the question we were looking into, and the analysis shows that the impact of the negative interest rate policy on economy is heterogeneous. In some big Asian economies like India and Indonesia, and in small trade dependent economies like Hong Kong, Philippines, South Korea, for instance, Singapore, Thailand, it will be different. And we understood that in the context of India, the inflation goes significantly high in response to the plausible negative interest rate, and that impact can be more severe for India and Indonesia than the small trade economies. And of course, if you look at the local currencies also can depreciate in the emerging market context in response to the negative interest rate. So it's not a homogeneous impact, impact if you float your interest rate to be low and even negative and even zero bound. So this is one question I want to highlight when we talk about monetary policy as a policy tool to deal with the pandemic, that reducing policy rates to take it to the zero bound interest rate or the negative interest rate, it has had its own repercussions. And look at the human development angle of that. Negative interest rate means, suppose if our parents put their hard-earned money, the pension money, in the bond market, negative interest rate means they won't be even getting what they have invested in the pension markets. So those kind of things, when you have the precautionary savings, This is like, it's going to be pathetic if you have the negative interest rate. And I understand that more than $6 trillion of the bond market, are allocated in the negative interest rate quadrant. So this we need to look into. The moment we think that reduce the interest rate, the economic activity will be triggered. And also in the context of European Union, they have done something else, like floating the bonds, which they call as emergency pandemic package, like PEPP. So that emergency pandemic package is basically, it's a long-term bond. They float it in the market, like the refinancing risk will be lower if you float a long-term bond. And you must have read a few columns by my boss, Ratin Roy. He's a director of NIPFP. He was arguing for some kind of war-like bonds. Like, in the wartime, we had consoles. So something like consoles, like the long-term bonds floated as a pandemic or the COVID bond, and that can also finance the requirements you need to deal with the pandemic. So, if you ask me what's the role of the monetary policy stance in deal with the pandemic, my answer to you is like, it cannot be done in isolation. It has to be basically a policy coordination between the Mint Road and the North Block. So this policy coordination is what I want to emphasize, rather than highlighting that central bank independence is quite relevant to deal with the pandemic. No. And I also mentioned, earlier that in the US, they have done with, this interest rate lowering. But recently, if you read the column by Stiglitz, you can see that he also raised the same concerns I mentioned to you, that can monetary policy in isolation deal with this pandemic? And if you are interested in little bit of a technicalities of the seigniorage financing or the monetization of deficit, you can read my paper. It's titled Fiscal Seigniorage. So to conclude, what I want to highlight is that so far, our country responded to the crisis with caution. We basically did liquidity infusion in the economy, and we basically did some guaranteeing, support system. But to me, more than this, we need to deal with the financing pattern of the deficit itself to deal with this pandemic. It's an out-of-box thinking, because we should not be overcautious to deal with pandemic, because then we will miss the bus for an economic recovery. Whatever it takes to deal with the crisis means we have to frame the policy also out of box. There is a debate, not only in our country, but in many, it's a global debate, like, should we go for monetization of deficit? In simple terms, it is nothing but RBI printing the money and financing the deficit. Long back, India has done this. Like, we have printed the money. It's not like printing the money and doing it directly, but through ad hoc treasury bills, we were financing the deficit. But we stopped that, fearing the inflationary pressures. And in the late 80s, the government of India and RBI entered into an institutional agreement to contain this monetization of deficit when C. Rangarajan was the RBI governor. But right now, Professor C. Rangarajan himself wants to unlock this provisioning of the scope of monetization of deficit. It's like seigniorage financing. Seigniorage is nothing but you have high-powered money in your country. So the change in high-powered money to GDP is your seigniorage. So when we talk about the monetary policy, we should not be confining to just the adjustments of repo rates, but also to think out of box regarding the seigniorage financing, or even the shift in the financing pattern of deficits from the bond financing to the seigniorage, or in the case of bond financing, you go for long-term bonds, because Long-term bonds will avert this refinancing risk in the short run, and RBI has done that to a limited scale because if I remember correctly, there was an Operation Twist program floated by RBI, and this Operation Twist program was nothing but it was like a simultaneous selling and buying of bonds, like short-term bonds were sold out and long-term bonds were bought in. So the simultaneity in the buying and selling of bonds and changing the maturity pattern or the maturity structure of the debt itself, that can give you some kind of a leverage to deal with the pandemic because of a refinancing risk will be little later. So that's one thing regarding the bond markets. And on the monetization side, go for it. But I am not advocating the unconventional monetary policy tool like helicopter money, because when Ben Bernanke was this Federal Reserve chair in US, he floated the idea of helicopter money, and he's like fondly called as helicopter Ben. But what exactly is this helicopter money? It is nothing but MFFP, money financing of fiscal programs. Or another variant of helicopter money is you helicopter drop money to the hands of people, money in the hands of firms, to avoid this liquidity squeeze, liquidity constraint. But in the context of India, I'm not advocating for this unconventional monetary tool to deal with the pandemic like helicopter money, but always we can do a threshold seigniorage financing of deficits because we cannot now afford to be stringent in our policies just because we don't have the stability of revenue. Because if you look at the finance ministry package also, that stability of the revenue was their concern when they were designing the public benefits or the public emergency package to deal with this pandemic, the coronavirus pandemic. So that's a point of worry. We should be erring on the side of, not on the side of caution, but on the side of generosity to deal with the pandemic, because we need to deal with the two kinds of crisis now. One is the macroeconomic financial crisis, and the second is the public health crisis and the humanitarian crisis mounting from the livelihood issues. And we cannot delay. The policy package cannot be delayed to deal with these two, because then the deaths from virus and the deaths from hunger results in our country. And whatever we announced was very delayed, and it is too little. So that's why we need to explore the unconventional, kind of policy package to deal with the pandemic. And finally, if students are interested in a little bit of theory, there is a theory called fiscal theory of price determination. Like our RBI's mandate is to look into the price stability. The only objective of RBI right now is price stability. That means to contain the inflation. But in the context of a pandemic, if the RBI is just focusing on the price stability, it may prove, disastrous. This objective function of RBI, just focusing on the price stability, happened very recently. In February 2016, RBI and Government of India entered into an agreement of a new monetary policy framework. And as per the new monetary policy framework, we were supposed to deal with only the price stability. But this fiscal policies of price determination is, prima facie, you can understand that it is a fiscal theory. Like your price determination is not entirely a monetary phenomenon, especially in the context of India, when RBI has a single mandate like price stability, and the price stability is not exactly a monetary phenomenon. What exactly are you talking about? There are a lot of supply side issues we need to deal with. So that monetary policy, fiscal policy, coordination is what I'm trying to emphasize when I talk about this fiscal theory of price determination. Because if you're interested in this, you can read the Chicago literature by Cochrane, Sims, Woodford, Leaper, they all argue, the fiscalist literature, that the price level is independent of monetary policy, but depend strictly on fiscal policy, and the price level indeterminacy problem can be solved by having the central bank peg the nominal interest rate at a level consistent to their desired inflation rate, rather than by controlling the growth rate and the money supply. It's a kind of inflation targeting scenario. But my quarrel with this regime is the interest, the inflation targeting regime, which we follow in our country right now. Do we, have a relook at the inflation targeting framework itself to deal with the questions related to the pandemic? Because inflation targeting regime, it's a rule, and before that, you can appreciate that there is a policy transition happened in our country in the monetary policy stance from the discretion of a policy maker to rules. So now it's a rule-based paradigm in the monetary policy. But when Dr. Y.V. Reddy was, chairman of the governor of Federal Reserve, the regime was different. Like the discretion of a policy maker was more relevant there. But over the years, we have seen different kind of, financial sector reforms package. And of course, Justice Krishna has led that fiscal, financial sector reforms, FSLRC, reforms, which he has already talked to you. He must have spoken to you, and he was like the chairman of FSLRC. And what has happened as a result of the FSLRC recommendations and other related recommendations like MISRI's International Financial center, and also the package by Urjit Patel of analyzing the new monetary framework, our country has shifted the monetary policy stance from the discretion by the policy makers to more or less a kind of rule-based paradigm in which the inflation targeting is everything. And as a part of the FSLRC recommendations, the regulatory functions of the RBI we are trying to reduce, because the single mandate of RBI right now is price stability. So as legal, the students of legal studies, you must be interested in, making a kind of analysis regarding the regulatory framework, regarding the, that IBC code and the other kind of, the legal things which are required to deal with the pandemic, and also in the normal times, because we floated all these regulatory measures in BC even before Corona. And I think my co-panelists will be speaking to you more about what kind of, the regulatory banking services and other kind of things to you. And, I stop here by just highlighting that in order to tackle with this pandemic, we need to deal with the coordination of the fiscal and the monetary policy package. And I am a researcher in the Fiscal Policy Institute. So the importance of the fiscal policy can never be undermined to deal with the pandemic, because of course we are dealing with the fiscal deficit to be remain at the 3% of GDP, but at the same time we have twin balance sheet crisis in our country, the bank balance sheet and the corporate balance sheet. So we are in a kind of, it's a multi pronged, complications in our country, in which we, legal experts, economists, the public health experts, the banking experts, we all have to be working together to mitigate this crisis. And with that, the importance of the stakeholders, rather than we remain in our island of excellence as an economist or as a banking expert, as a legal expert, we need to work together. And that stakeholder, the importance of that stakeholdership is very relevant to mitigate this crisis. And I stop here and looking forward to listen to my co-panelist. And thank you so much once again, Professor Amarpal, Anmol, and of course Zubair, for giving me the opportunity to speak to the students of legal studies. And I really look forward for further interactions with you. Thank you.
Thank you so much, ma'am, for your wonderful and insightful presentation. It was highly informative and comprehensive. Now I move to the second panelist, second keynote speaker for the day, Dr. Anuj Kumar Baksh, who is Associate Professor at USLLS GGSIPU. Presently, he is posted as Associate Director in Department of Academic Affairs. Sir has wide experience of teaching and research for over 20 years. Sir has also wide experience of teaching disaster management courses for MBA students. His topic shall be challenges to banking system in COVID-19 phase. Sir, over to you.
Sir, unmute yourself, sir. Sir, unmute yourself.
Am I audible?
Yes, sir. Yes, sir. Please, sir.
Am I audible now?
Yes,
You are
sir.
audible. You are
Yes, sir.
audible, Anuj bhai.
Dubey?
Yes, sir. Yes, sir. Please continue, sir.
Okay, sir. Okay. My respected Dean, sir, the distinguished speaker, Professor Lekha Chakraborty, my worthy colleagues here in the department, the students and other participants attending this webinar on an extremely relevant subject, that is the challenges to the banking sector during this pandemic. I convey my I look forward towards this presentation from the perspective of looking at from a disaster management perspective. I have been associated with disaster management for quite some time, so I thought it may be useful to reflect on the overall scenario or the services which the banking sector can render in this pandemic during this COVID-19. I borrow the words of my previous distinguished speaker, what he said about the present RBI governor, that whatsoever we need to be doing during this COVID-19, that should be done by, of course, the RBI and all the banks which are under the supervisory control of the Reserve Bank of India. And so we may have taken note that even before the finance minister of the country came before the public to announce the stimulus package, special stimulus package for this COVID-19, at least the Honorable RBI Governor at least came thrice in the public to announce various kinds of measures which the RBI was to take and to announce to do how to minimize the sufferings arising during this pandemic. He was the one who possibly, even before the government may have responded, he announced the moratorium, 3 months, and then of course 6 months for the loans, so on and so forth. So where I'm trying to connect it, usually pandemic people associate this with what is called public health crisis. It is indeed a public health crisis of an unprecedented nature, possibly unheard by last 2-3 generations of the mankind. Almost every system, every structure, every individual on this earth is impacted by the scale, by the nature of COVID-19, the pandemic. There is hardly any individual who can claim that he is not or she is not stressed by this. Every person living on this earth, we are stressed. And because the human beings are stressed, so all the processes of the human being, be it administrative processes, be it judicial processes, be it economic processes, be it social processes, everything is impacted adversely. And that is what the challenge has been put by this pandemic on us. So the challenge is to, of course, lots of suffering, lots of constraint, disruptions everywhere. A variety of issues are coming in. Challenge is to minimize the suffering, whatsoever it can be done as of now. Prepare ourselves for a better world post-pandemic. And in this whole scenario, where do we keep the banking sector? And that is the focus of this lecture. Now, Ajriga, I was very carefully listening my previous speaker, and professor of public policy and finance, I see it. She has given a very, very elaborate understanding or say deliberation on the specifics involved in the overall response of the banking sector. I would look at these four more from the perspective of a consumer of the banking sector. And when I say I, it means possibly 130 crores of the people in this country who are recipient of the services of the banking sector, directly, indirectly, during this pandemic. So from this perspective, what are the challenges? Before I go further, let me clarify. Our banking sector has been going through various kinds of structural reforms for quite some time. More specifically, since 1991, we liberalized significantly, we privatized significantly. The manner in which the loans, the credits were to be extended, all those have been overhauled. The issues of frauds, mind-boggling kinds of frauds have been coming up. In spite of that, we have fairly stood our ground as a nation. 2008 recession, we did quite well. But nonetheless, there were limitations, and for quite some time, maybe a couple of decades on, one of the focus of our country has been to strengthen our banking sector, appreciating the fact that banking sector has to play enormous role in the development of the economy. So how do we restructure our banking sector to get best out of this in terms of development of our economy? That is one important agenda in which we had been involved for quite some time, except for this pandemic, when it was almost like a bolt coming from the blue, when we seem to be rebooting ourselves, we seem to be changing our orientation, we seem to be changing our focus from the normal banking reforms to a more structured, more focused renderance of the banking services to minimize the impacts of this pandemic during pandemic COVID-2019. So challenges of the banking sector in general would be one issue. But challenges of the banking sector in delivering its response to COVID-19 would be altogether different issue, although working under the broader framework of the structural limitations of the banking sector. So how do we look at this challenge, which requires the banking sector to do their best, as would be expected out of any of the institutions of the society during this pandemic. So having clarified this two aspects, general challenges of the banking sector is one issue, but within those limitations of the banking sector, how do we do our best to provide the needs of the society during this pandemic is one issue. From this perspective, I have identified a couple of challenges. So let me go to those challenges one by one. The very first challenge I see, the banks were working in their normal state of affairs. From that normal state of affairs, of course within the limitations, they are certainly required to do lot many things, expedite their say delivery services, provide ensure liquidity, ensure say flow of currency in the society, provide easy loans to the people impacted by pandemic. There are thousands and thousands of people who are still not connected with the banking sector in our remote area. and they are the one who have been most adversely impacted by the pandemic. So how can bank connect with them and for this specific to this pandemic and try to elevate their suffering? So change from the normal functioning structure to coming in the emergency response mode, that itself is a major issue. When we are talking of the banking sector, please remember we are talking of number one, of course, the Reserve Bank of India, which is the regulatory institution of the whole banking sector. We have around 34 banks, 22 private banks, 12 public sector banks. The total number of employees involved are in the range of around 15 lakhs. Then overall control of the government of India, the finance ministry. So this whole sector consisting of so many kinds of people, how do they get into this mode of emergency delivery of the services during this COVID-19? This itself is a major challenge. You would have appreciated that during this lockdown period, almost all, everything was under lockdown. Banks were open like any other, emergency service provider, say the shop, medicine shop, say the hospitals. Similarly, even the banks were open, the ATMs were working. There were people who were coming to the ATMs, they were refilling the currency notes to enable the people to be easy, to be comfortable with the liquidity of the money at their command, so and so forth. So at least this time we appreciated that even banking is a kind of emergency service provider. And if it is a emergency service provider during this pandemic, it has to be so well prepared in delivery of its services as would be expected from any other emergency service provider. So how it can be done? I am happy that not once, even I was listening a couple of times when the RBI governor came to the media, and the focus with which he was trying to lay out as to what kinds of new schemes the RBI has come up during this pandemic. Now, when they came up with the moratorium scheme, the moratorium scheme was approved. Very next day, I received SMS from my bank. Will you be interested in this moratorium for your housing loan? If yes, please send us an SMS, and OTP was provided. And the third day, I received a SMS from them that my request for moratorium has been accepted, and so I will not have to pay my housing loan EMIs for next 3 months, and now it's next 6 months. I was surprised by the way by the convenience this whole scheme was rendered to me as a consumer of the banking sector. But this is so far and so good. So change from the one normal delivery services to other. Then the second challenge is the dynamism, I would say. Remember, this pandemic, it doesn't give a stable situation. It's all disruptions. It's chaos, it's confusion, it's only breaking away of the things. And amidst this, every day, every minute, every hour, things are changing up. New kinds of ideas are coming. New kinds of perspectives are coming. The banking sector as a process has to receive to the new ideas which are coming and respond to the new kinds of challenges which are being thrown up almost every alternate day. In disaster management, we say every disaster has 4 phases. The one, the impact phase; the other, the relief phase; the third, the rehabilitation phase; the fourth, the reconstruction phase. as a disaster moves from the first phase, that is the emergency phase, to the last phase, the reconstruction phase, the impact of disaster diminishes and our resilience to recover from the disaster starts bringing results to make our society better. And this is one disaster where the emergency phase itself has had dragged on so long. It has almost been over 3 months now that we are still caught up in this emergency phase. The graphs are still not flattening. They are increasing. Yet now we have also opened up our economy, so on and so forth. So even during this emergency phase, how do the banks reorient their services in terms of more expeditious, more convenient, more liberal, more generous rendering of the services? As we move beyond the emergency stage, the stage of relief shall come. That will require new kinds of responses. And as from relief we move on to reconstruction phase, even that will require a rehabilitation and reconstruction phase. That will again require new kinds of responses from the banking sector. And please remember, when I say banking sector, I start with RBI till the last person employed in the banking sector, of course, with all the structural entities who are connected with this. So how dynamically they grasp the challenges and respond to this, that is another major challenge, I would say. The third is the coordination within the banking sector. Please remember, the banking sector, of course, it is supposed to be an autonomous sector under the overall regulation of the Reserve Bank of India. Not only autonomous, it is also supposed to be a commercial sector where the banks are supposed to be making profit for the good of their shareholders. But this is not, making profit is not only the good thing for which they remain in the society. They have to render good services in the society. Their utility ultimately lies in how better they contribute to the economic development of the society, and how better do they contribute to the challenges of the society. So for a while, at least during this unprecedented pandemic, which is global in nature, which is unprecedented in scale, which spreads merely by the air, by the touch of unknown kinds of persons. All of us are potential victims. So frightening kinds of challenges. In this challenging situation, how the banks do coordinate among themselves collectively to provide the best kinds of services. And when I say coordination, I start with the Reserve Bank of India, which has the responsibility of administering the monetary policy of the country. It floats down to the level of the banks, and banks gets them executed through their employees. Employees includes officials, it includes staff, so on and so forth. And all these operations has to be done within the overall framework of the government policy. They cannot just afford to much deviate from the approach of the government. So maintaining coordination with the government on the one side, with the consumers on the other side, with the Reserve Bank of India on the other side, the structural limitations, procedural limitations of the bank on the yet another side, and working towards one single objective, that is to be doing what all it requires during this pandemic, with what I say, the commonality of the approach. All these entities directly, indirectly associated with the banks, they have to carry what is called commonality of the approach. And why this commonality of the approach? Only to enhance their capability, only to enhance their efficacy in the renderance of the service. So coordination and building up for commonality of the approach towards providing the services, that is yet another challenge, because it's a huge sector. We are talking of roughly around 15 lakhs of people who are associated with it, who are working. Almost all banks are supposed to be autonomous in themselves. They are supposed to be a commercial entity existing for profit primarily. But during this pandemic, all these considerations will have to be kept aside to provide, to address the demands of this pandemic with a collective coordinated approach. The fourth, I would say, how do we often, a term which has come being used nowadays, the prophets of doom. The prophets of doom. This phrase was even stated in the Supreme Court with respect to certain kinds of criticism which has been thrown up with the government. Of course, without going into the criticism which has been leveled, a merit of those criticisms. From the banking sector, some of those criticisms are quite relevant. There are people who are trying to convince us that economically everything is going to be bad and from bad to worse. The economy is shrinking, GDP is sinking, the commercial activities are just vanishing, Sensex is falling in variety of, I would say, professionally packaged sensational cynicism. All these things are coming and the media is just full of these kinds of things. If one hears these kinds of cynical statement, it would make one convinced, oh my God, life is no good for anything to live further. Imagine if the CMD of bank is also convinced by these cynical statements. He would tend to be conservative in his approach. He will try to keep as much conservative in rendering of the services so that one is least impacted by this pandemic, and that will prove to be disastrous for the economy as a whole. We all understand that this is not a normal situation. This is what was said by my previous speaker. This is an abnormal situation, and during this abnormal, unusual, unprecedented situation, we have also to be prepared ourselves in rendering of the services in an unusually, robust manner. Any cynicism which comes in the way of our rendering of the services is going to only make our response, response much more poorer. And the more poorer our response are, we are actually aggravating the issues about which the whole cynicism is there. Our whole criticism is there. So to the extent one should be appreciative of those limitations which the economy or the challenges which the economy is going to throw on us, we cannot possibly avoid them. Had we were in position to avoid them, we would have avoided. But we all understand even the richest of the rich country have failed in managing this pandemic. The shrinkage in the economy, the falling in the GDP, the shrinking of the commercial activity, all would come. But our challenge is that within this limitation which COVID-19 puts us, how effectively do we respond only to get better than from the point where we are left with? That is called resilience. How do we build up on our resilient capability as a nation, as a sector, as an commercial sector, as an economic sector, as the banking sector? All of us are blessed with resilient capabilities. The challenge is to press this resilient capability at its best to render best kinds of services. When I say best kinds of services, please remember, of course, I would want the banking sector to be very, very generous in their approach, very, very liberal in their approach, very, very efficient in their approach. But just to clarify, I wouldn't want the banks to become a charitable institution. They can't become charitable institutions. The day they become act like a charitable institution, that will be end of the banking sector, creating yet another disaster for the economy. But without becoming a charitable institution, uh, uh, besides being a professional sector, a professionally managed sector, yet there is tremendous scope, tremendous avenue for liberally rendering our services to minimize the difficulty arising out of this pandemic. I know that there are around 80% of our population, even now, who are connected with the banking sector. And for a person like me who is getting a salary every month, I also have the privilege to so conveniently get the avail the monetarium scheme of my loan provider, the bank. But I was frightened to think of the people who do not have a banking account, and if they are in need of a credit, a loan for say health services, how are they going to get that? And please remember, around 40 crores of our population, they are still not connected with the banking sector. And those who are connected with the banking sector, as we move beyond Delhi, the capability of the banks to render the provide the services, that also shrinks. This is the limitation within which we have to operate. So those who are connected with the banking sector, provide them best services, most efficient, most liberal, most convenient services. Further extend your arms to the people who are still not connected with the banking sector. If they are in need of credits, the loans for during this disaster, please provide them. The government has, I would understand, at least I would rate it that way, that government has provided very liberal scheme for stimulus. Those stimulus scheme rendered, provided or announced by the government can be relied upon by the banking sector to connect with those people who had yet not been connected with the banks and do whatsoever best can be done. When I say this, again, trying to make a difference between a charitable institution and a professional institution, I look forward for professional services from the banks, not as a charitable institution, but as a professional institution, which are a part of a very, very sensitive sector of the economy, that is the economic sector. And please remember, if the banks do not respond in this manner, what will happen? The money will remain in the chest of the banks. And Professor Amartya Sen would remind us of 1943, famine of Bengal, when the grains were lying in the godowns of the government, and people were dying on the streets without the food, with hungers. The grains were getting rotten in those godowns, but because of the delivery problems in the delivery issues and variety of other factors, although grains are there, but people were dying because of the hunger. That should not come the situation here as we are talking of. The banks have to move forward very cautiously, but liberally to provide services not only to the people who are connected with the banks, but also to the people who are still, unfortunately, even in this, say, 21st century, they are not connected with the banking sector. Then then the next challenge, which I would say, is to challenge of maintaining, maintaining the health of the staff, the health of the infrastructure support system, the health of continuity of the services, the health of the bank itself in terms of its books of accounts, MPH, etc., etc. On the one side, I might be arguing for liberal services, but again I say that those liberal services can only be extended by such institutions who could successfully maintain healthy, healthy manpower, healthy economic, structures of the bank. Without compromising on this, how do the banks continue with the least of disruption? As I say, this pandemic would affect almost everybody. It must have also affected employees of the bank. It must have also affected the infrastructure support system of the bank. It would also affect the commercial activities of the bank. But despite this, how better these disruptions can be minimized to render best of the services in this kind of challenges which have been put. Because if the employees of banks are adversely impacted, if their infrastructure support system collapses, if they collapse economically and commercially, of course, what we are expecting from the bank, that would be a disaster, a kind of continuation of the disaster, a kind of aggravation of the disaster, which needs to be resisted. They have to be prepared enough to be prepared enough to, while responding to the pandemic, they themselves do not get caught in this this disruptions arising out of the pandemic. So broadly, these kinds of challenges I see more from the perspective of recipient of the services of the banking sector, not an insider of the banking sector, from the perspective of the disaster management. And while saying so, I 100% honor, respect, and revere the sentiment of RBI governor that whatsoever needs to be done, that has to be done during this crisis. And this sentiment was so well reverberated by my previous speaker, Honorable Professor Lekha Chakraborty. I sincerely acknowledge her inputs in this whole debate. Although because of my limitations, I cannot get into those specifics of monetary issues. But from the perspective of a recipient of the services, I have tried to identify some of the challenges. And with this, I wind up my lecture. Thank you so much. If there be any questions, of course, I can say. Thanks, Javed. Thanks, Dean sir. Thank you.
Thank you very much, sir, for your insightful deliberation into what all different sectors the banking sector system needs to look upon to resilently face the challenges posed by COVID-19. Now we have a couple of questions by the participants for our respected panelists. So the first question is for Professor Chakraborty. The question has been asked by P. Vasishtan. The question is, what do you think could be an alternative to helicopter money, albeit it's time consuming? What about the price stability, at this point of time?
Professor Lekha Chakraborty, are you there? Professor Lekha, yes.
Hello.
Yes, ma'am.
Am I audible?
Yes,
Okay.
ma'am. Please proceed.
Yeah, sure. I have seen the questions in the chat box, by Vasishtan and Yogita. Yogita was asking question to Professor Anuj. So let me take up the questions by Vasishtan. His questions were regarding this helicopter money and also about this price stability. Okay, let me respond to that price stability. And as you are the students of legal studies, let me give you a little bit background in a minute or two regarding the legal framework of this and get into the question, your question on price stability. So it's like, central bank independence when we interpret it is not the independence regarding the goal. It's not the goal independence. As you rightly mentioned, our goal, that price stability is fixed. So what is the independence we are seeking right now? Instead of RBI governor taking the decision, now we have a monetary policy committee. So it's like we are seeking the independence in terms of operational flexibility. So it's an operational independence rather than a goal independence. You are right. The price stability as a goal is fixed. Now, under the section 45 ZL of Reserve Bank of India Act 1934, this monetary policy committee meetings are taking place, and on the 14th day of the meeting, after every meeting, these minutes of the proceedings are uploaded in the RBI website. And the student should take a look at it. And these are very interesting documents, that interface between the legal and the monetary policy stance is very clear in these documents. So the student should take a look at it. Whenever you have that monetary policy committee announcements, you should not just confine to just the policy rates, whether it is up or down, but from the legal perspective, you should look into this document. And, there are many members, most of them are academicians. And right now, we have Chetan Khate, the professor of Indian Statistical Institute, as a member. Pami Dua, the former director of Delhi School, as a member. Then Ravindra Dholakia, the former professor of Indian Institute of Management, Ahmedabad, is a member. Then the officer of RBI nominated by the central board under the section 45 ZB 2C also attend the meeting. And right now, its executive director is Dr. Janak Raj. Then you must be knowing about Dr. Michael Patra, who is a deputy governor. And of course, it's chaired by Shri Shaktikant Das. So they have a voting pattern, whether to increase or decrease the repo rate based on the conditions of price stability, the domestic and international scenario. They have to take the decision. And this resolution adopted at the meeting of the Monetary Policy Committee, and the voting pattern or the vote of each member of this Monetary Policy Committee, they are uploaded in the form of these minutes in the RBI website as per this section 45 ZL. And this document is a very rich document for the legal students because it's an interface between the macroeconomic policy and the legal field. And your concern was regarding the price stability. So these decisions to reduce the repo rate under the liquidity adjustment facility and the marginal standing facility and the RBI, that corridor decisions, all these things are taken in consonance with the price stability aspects. They look into the economic growth, they look into the global economy prospects. It's not only the internal factors that affect their decisions, but the global financial markets, its turbulence, everything. All these points are taken into consideration while coming to a particular point on whether they will be maintaining the status quo or increase or decrease the price, the repo rate. So it's like you are moving your repo rate up and down based on the price stability. And right now, our consumer price index inflation of 4%, and that is very well within the band of plus or minus 2%, and that's supporting the growth. So that's why they have come up with the decision of lowering it. So it's like, but you can also ask me that whether the voting pattern will be in consonance or there will be a majority voting pattern and all. Of course, in this recent Monetary Policy Committee decisions also, all the MPC members, excluding Chetan Khate, has voted for the reduction by 40 basis points, but Chetan Khate voted for 25 basis points reduction. So all these details of the voting pattern and the decisions you can enjoy if you read that. So that I highly recommend to you. And thanks so much for that question, Vasisht. Of course, the price stability is taken into consideration and it's under control. But in other countries, one more thing is there, like the RBI governor or the Reserve Bank governor get a bonus if the price stability objective is maintained, and he has to come and argue it out, or deliberations have to happen in the parliament if he's not maintaining that price stability. But in our country, that kind of institutional structure is not there, that the RBI governor is going to get a bonus or not. Definitely he will get the bonus, because he's like very well on board regarding the price stability. And your second question, I quickly respond regarding the helicopter money and what are its, the kind of alternatives. Of course, the helicopter money is very relevant in the context of, pandemic, because you have to just see the inflationary pressures of the helicopter money. But right now, I am not advocating helicopter money beyond a point, because as I mentioned to you earlier, there can be three kinds of variants to the helicopter money. One is the money financing of your deficit. Second is like giving helicopter drop money into the hands of people and the firms. So what my limited point, during my presentation, what I argued is for the money financing of fiscal program, that is a monetization of deficit through a threshold limit. But I am not arguing for helicopter drop money in the hands of people, because precautionary savings we need to see. And Raghuram Rajan has rightly pointed out, when he was responding to the effectiveness of helicopter money, he also mentioned that if the precautionary savings, if people save the money instead of spending, helicopter money as a monetary policy tool fails to trigger the economy. Because the spending, the demand stimulation will not happen, even if you are helicopter dropping the money, if people prefer to save rather than spend. So that's a limitation. So what could be the alternative? Quickly, in the context of European Union, both Christian Lagarde has come up with the pandemic emergency purchase program, or the policy package designed by Shaktikant Das, Sri Shaktikant Das, in the context of India. What we are trying to do is to absorb the shocks of the current crisis by helping the economy to lower their borrowing cost, increase the lending, and help the citizens, help the firms to access the fund and to weather the crisis by infusing the liquidity into the system. So that kind of an asset purchase program is what we are focusing, rather than monetization of deficit at this moment. So the monetization announcement has happened only in the form of ways and means advances. And of course, we are keeping our key interest rates low, so that the borrowing cost will be lower. But you can also always counter argue with me that the repo rate is only the rate in which the RBI lends to the commercial banks. The way the commercial banks lend to the citizens, that monetary policy transmission is equally relevant, so that the policy will be effective. So we are waiting to see whether that policy transmission, that monetary policy transmission, is taking place in our economy. Of course, some of the banks like SBI has gone ahead bullheaded by reducing the rates. Let's see how it's going to be with the other things. So it's basically access to the credit by the firms and by the households, and to ease that liquidity constraints. So these are the kind of the policy measures we have adopted. And over to you, Professor Anuj, for the points, basically what Jane was asking. Thank you for that question, Vasisht.
So the next question that we have is by Ms. Yogita Jain. She asks Dr. Anuj Baksh, sir, how can RBI deal with the financial crisis in India in this pandemic situation, where risk of bank frauds have increased to a great extent, keeping in mind the fact that rise in bank frauds have been seen consistently during past few years, despite many policies and legal frameworks for the same?
Anmol, can you repeat the question again, please? First part I couldn't hear.
Sure, sir. Sir, Yogita asks, how can RBI deal with the financial crisis in India in this pandemic situation, where the risk of bank frauds have increased to a great extent, keeping in mind the fact that rise in bank frauds have been seen consistently during the past few years, despite many policies and legal frameworks for the same?
Okay. Please remember, Yogita and others, I differentiated in two kinds of challenges which a banking sector, of course, the RBI and other banks are facing. One is the challenges which we had been facing even before to pandemic. And those challenges, of course, have been, NPA has been one issue, and thankfully IVC code things to some extent have been taken care. And then a number of frauds which are getting reported, most recently PNB and others. Those challenges do remain, please remember. But even we were out from those challenges, we are caught up in yet another humanitarian crisis. And during this humanitarian crisis, our priority are more towards meeting out the humanitarian requirements of the society, then of course going ahead with the strict structural changes which are required to meet out those challenges of frauds and those challenges of NPAs, etc., etc., etc. Somewhere, of course, it has to be balanced. As I said, that money cannot just be distributed, but the people who are in need of money, the say in hospitals or say for other kinds of things, this delivery of the services can be done in variety of innovative and more convenient manner. I am more concerned with the challenges arising in delivery of the services of the banking sector during this pandemic. How RBI and how we as a society respond to other challenges which have been going on in the society. Of course, we have taken certain measures. We would still look forward to strengthen those things post-pandemic. But during pandemic, at least I understand, our orientation, our priorities should be very clear. That is to ease the liquidity in the society, to easily lend, say, credits to the people who are in need for variety of purposes, so on and so forth. This is all I can say on this.
Okay, so we have the last question for the day by Ms. Kalpita Ray, directed to Professor Chakraborty. The question that Ms. Kalpita Ray asked is how the labor law relaxation with fiscal and monetary policy can resolve the crisis.
Thank you. Thank you, Kalpita, for this brilliant question. To answer this, let me quickly tell you the regime we have in India is inflation targeting. This labor laws and the monetary linkages are quite strong in the inflation targeting framework in those countries where the potential output and the actual output are measured in terms of employment. But in our country, this potential output is measured in terms of GDP. We call it as, native economies like natural rate of employment or unemployment. Those kind of aspects are getting into the monetary policy framework in the context of US and in the European Union, because employment is a direct objective of the central bank policy or the monetary policy. So, in those countries, these linkages will be strong. But in our country, if you look at the inflation targeting framework, the two components, one is we have the inflation anchor, which Vasisht was mentioning about that price stability. Then we have the inflationary expectations. And when you look at the inflationary expectations, you know that it's an unobserved variable. And our RBI has floated the expectation survey to get this variable on board. And on the next part, the next component of that potential output minus actual output, that we call as an output gap in our country, is a gap between your potential GDP and your actual GDP. It's not in terms of employment. But if you look at the inflation targeting equation of US or in the context of other countries, that is in terms of employment. So that is a difference in the link. Then now let's look at quickly what has happened in our countries. In certain states of India, we have gone for the labor reforms through that ordinance route. You legal students will understand it better than me. So we need to ask the question whether that quick rushing up the ordinance route was the right answer or a tripartite agreement between, the industrial relations, the government, the laborers, and the management. That kind of a tripartite agreement and getting into the labor reforms is more crucial. That's what we have to check with the labor reforms happening in our country at the subnational level. But this kind of linkages you're asking me between the labor reforms and the monetary policy reforms have got only a limited impact in our country because our output gap, that potential output, is measured in terms of GDP. And as I mentioned in my presentation, that potential output, that potential GDP, we are arriving at through a sophisticated econometric methodology rather than going into the, the kind of envelope or other kind of methodologies. And in our country, the monetary policy does not have direct link with employment, unemployment statistics. Okay. But if you want to know this link between labor policy or the labor statistics and the monetary policy, then we have to get into the how Fed behaves. The how US Federal Reserve look at the unemployment statistics and frame their monetary policy. So that's kind of a global context. And if you have further questions regarding that, you're always welcome to interact with me on my Twitter handle, and Subair can share with you the Twitter handle with all the students, and I am ready to interact with you guys. And thank you so much once again for that question. Yeah. Kalpita, thank you.
Thank you very much to both the panelists for today. Their deliberations have been highly incisive and informative. Now I invite Dr. Zubair Ahmad Khan, who has been the faculty coordinator for the two-day program, to give the vote of thanks.
Thank you, Anmol. Thank you so much, respected Dean, sir, for the helping us and providing us platform for organizing such an event. And I'd like to give my sincere gratitude to our both keynote speaker, our first keynote speaker, Professor Lekha Chakraborty, who has discussed many important issues regarding monetary and macro policy, where Madam has discussed about the how public health and macro policy may act as a demand and supply also. And for fighting the economic disruptions, we have to observe and regulate economic diplomacy also. And there she discussed about economic firefighting also. Madam has discussed about the IMF and its role in the altogether, and how IMF has taken a number of initiatives during these times there also. Madam has also discussed about many other crucial issues altogether. For example, she has discussed about the recent RBI initiative also with regard to moratorium, also has been discussed by our keynote speaker also. And the most important thing where the Madam has discussed about negative interest rate policy, which seems to be very important altogether. And for law students and for the non-law students also, this is a very good area of research altogether. There have been many questions. There have been one question has been raised regarding helicopter money, which seems to be very important in nature altogether. And for law students, LLM students or LLB students, the relevant economic theory which Madam has discussed, that is the financial fiscal theory of price determination, it seems to be very important in nature altogether. And the most important thing, that is the rule-based paradigm also. Now today, the whatever reform package which we have given, it is very much important to understand and comprehend the overall policy regulation of IBC principles. Thank you so much, ma'am, for discussing a holistic perspective of monetary and macro policy. We have another keynote speaker, our colleague, Dr. Anuj Bakshi, Associate Professor. Sir has discussed a number of crucial issues with regard to challenges in the banking sector, where he discussed, where he initiated his talk with the consumer of the banking sector also. The number of issues of frauds and NPA, which has become a matter of concern for the last 20 to 30 years also. And there's where he has discussed and emphasized upon the normal banking reforms to the render banking structure, keeping in mind the number of laws and legislations which we have received from the last 20 years. The banking restructure seems to be one of the important areas. And that is why in his paper, he clearly mentioned altogether the plight of the poor people living in the urban area or living in the semi-urban area or living in the rural area. There are all those people who are not still connected with the banking facilities, modern banking facilities, and even with the banking system. There are many unbanked areas also. And where he also discussed about the stages of relief, which is important. Of course, it is very much important that everything cannot be done in one go. We cannot walk in isolation. That is why he discussed about the various phases of various stages of phases also, starting from the reconstruction phase and from the disaster management phase also. Sir has also discussed about the other obstacles which we are facing in terms of the liquidity also and in terms of financial instability also. And there he discussed about overall the possible solution. Thank you so much, sir, for accepting our invitation and giving your experience with all of us. So this is the end of the second panel discussion also. Respected Dean, sir, with your permission, can we start with the technical session 1 also?
Please.
Yes. So thank you so much, our keynote speakers. Now we are going to start with the technical session 1, and then the technical session 2. So I request Mohit Tamar, without wasting time, to call upon the first speaker and to discuss his presentation altogether. And I like to request all the presenters to discuss only the core issues, your suggestions and concluding observations specifically also. Mohit, over to you.
Thanks a lot, Zubair sir. The first speaker for the day for the technical session 1, which has been themed as the modern banking services in India. Our first speaker for the day is Dr. G. Mallikarjun. Sir is a professor at Commonwealth Institute of Justice, Education and Research, Lloyd Law College, Greater Noida. The title of his paper is Need for a Financial Grievance Redressal Authority in India on the Lines of Financial Ombudsman Service of United Kingdom. Over to you, sir.
Good morning to all of you. So hope I'm audible. So
Yes, sir, go ahead.
Okay. So I would like to give a background to this. We are all aware of the importance of financial system. The financial system consists of 3 components basically. One are the intermediaries that are involved. Second is the markets where the instruments are transacted. And the third is the payment and settlement system, which acts as a circulatory system through which the entire process is handled. So that being the case, introduction of a lot of people into the financial system is very important because this has a direct bearing on the economy. More number of depositors coming into the banks will provide more funds for lending, and in turn will provide an opportunity for more people to be benefited out of it, more investment activity and more economic prosperity. Similarly, participation of more people in the markets like capital market and foreign exchange market, etc., will enable the triggering of the process relating to the economic activity, providing funds to the companies, providing mechanisms of mobilization of money for those companies, and then in turn the economic activity. Foreign exchange market in terms of providing the foreign exchange transactions, which will ensure that the import and export and the balance of payments aspects can be handled. So the activity in financial system is directly related to the awareness relating to financial system and the utility of this awareness getting translated into financial inclusion. So we are talking about 2 elements here. One is financial education. Second is financial inclusions. Only when you are aware of the benefits of it, you will be getting yourself included. How much ever you may have Jan Dhan program, unless people are aware of the importance of it, you will not be in a position to join in. How much ever people, there are so many agents who are bombarding you every now and then about the insurance policy. Unless you are made known about the utility of the insurance policy in terms of checking your risk and also protecting your next to kin after your death, you will not be in a position to build about insurance inclusion. How much ever committees you have in terms of building the corporate debt market, unless people realize that there is worth in terms of investment in it and even mutual funds, you will not be in a position to participate in those environments or in those instruments. And as long as the participation is not there, the economy is running at half capacity or lesser than that. As Sir was indicating previously, we only have about 60% in spite of all the initiatives of people. In case of insurance, it is much low. So financial education is a mechanism by which you are going to provide this input. The next part of it is you get into the system thinking that it is going to be good. But if the experience turns sour because of a complaint, and the institution which is providing you with this, which has provided you with the service, is not providing you with the redress, the next important part is financial consumer protection. So the disillusionment which is there is going to have a contagion effect in terms of telling people through the word of mouth, saying that इन्होंने advice किया कि करना चाहिए but ये बेकार रहा, so I will not be in a position to participate. So वो जाएगा और 10 लोग और लोगों को लेके साथ जाएगा. So from that perspective, it is very important that financial consumer protection should be given an equal weightage, if not a better weightage than the efforts that are taken for financial inclusion. So in financial consumer protection, you have internal grievance redressal mechanisms which the institutions themselves provide. If these mechanisms are sound enough and effective, there wouldn't be need for any other redressal at all. But the problem is that these institutional redressal mechanisms are skewed more towards the institution rather than to the consumer. And that is where you try to look out for alternatives in terms of getting your grievances redressed. The first alternative that was there is you didn't have a Consumer Protection Act till 1986. That was the first which came as an alternative thing. Your Arbitration and Conciliation Act came subsequently, but it requires a contract with an express clause for arbitration and conciliation. So those are different. So why not? In Sweden, you had a model of ombudsman which was operational. So bring that ombudsman scheme. And the first one to be implementing an ombudsman scheme in the financial system is Reserve Bank of India for the banking system. And over a period of time, it was introduced in 1997. And the power was not through any act or a direct provision introducing this ombudsman scheme, but in the form of a ability of the regulator to give a direction. And as a direction, this banking ombudsman scheme was introduced. There were a lot of changes which were brought about. It was started in 1997. There were several revisions, about 4 to 5 revisions in terms of expansion of grounds of deficiency, and also in terms of Reserve Bank taking over the operation of the system, then bringing in more and more kinds of business as and when the banks started dealing with non-banking financial products, dealing with malpractices in terms of recovery so that their non-performing assets levels could be checked. Then in terms of bringing about internet banking, ATM cards, debit cards, electronic banking, etc. So with the evolution of banking, parallelly, the banking ombudsman scheme also evolved in terms of providing succor. And as of now, you find that it is a very effective system. It has redressed close to 1.95 lakhs complaints, of which about 50,000 odd complaints were in favor of the customer. So this is an alternate grievance redressal mechanism. And looking at this model, the first regulatory setup or another sector apart from banking which started this was the insurance sector, which started it through the redressal of public grievances rules in 1998, which were introduced by central government, not by the insurance. There was no regulator of insurance at that point of time. So subsequently, this redressal of public grievances rules provides for insurance ombudsman, and these insurance ombudsman, the system has not been very effective because the appointments are made by government. The regulator came in, and regulator is only in charge of being the head of the selection committee. In case of Reserve Bank banking ombudsman and the subsequent ombudsman which came about, these are introduced by Reserve Bank of India. The people who are ombudsmen are selected, and they are persons who are working as general managers or chief general managers of Reserve Bank of India. And there is a mechanism of award which is specified. The amount of compensation that can be given is 20 lakhs. And in case of NBFCs, it is 10 lakhs. And more importantly, there is a provision for appeal where an appellate authority who is administering the scheme is examining it. And then, by and large, most of the grievances get solved there. But in case of insurance ombudsman, there is no provision of appeal. It says that the decision of the insurance ombudsman is final. But whether the decision is managed, is complied with or not, there is no mechanism which is stated there. It is given again as a direction. In fact, if you see, originally it was given under section 114 of the Insurance Act. Now it has been given under section 24, but there is no mention of the provision at all. It is a general power of making rules under which the rules have been framed by central government. So, and more importantly, in case of banks, it is a serving officer. So he will retire at 60. But in case of insurance, and similarly in case of PFRDA, they are all people who are in the retirement mode. So in case of insurance, the age is up to 60, up to 70. And they are either district judges, civil servants, or insurance professionals who have retired, who are going and sitting there. So the approach that is adopted in these cases is also quite different. You can see that there have been instances where the complaints have been pending for more than a year. About 40% of the complaints are handled in more than 3 months duration. And appointments is always a problem. Only now they have 17 ombudsmen who are all operational. Otherwise, there were at least 10 vacancies all through. So that is the impact. In case of SEBI, you don't have, they had an insurance ombudsman, they had a SEBI ombudsman scheme in 2003. But for whatever reasons, they have scrapped it up in 2007. And what you now have for grievance redressal is something called SCORES, which is SEBI Complaint Redress System. So it is just a system where you will park your complaints. It goes to the intermediaries or the listed companies who will redress the complaint, put in their feedback. And that is all with it. The only way in which SEBI intervenes is if someone has not resolved his complaints, then exercising the power of imposing a penalty, they will impose penalty. But whether your grievance has been redressed, whether you are satisfied with it or not, doesn't count for anything as far as SEBI is concerned. The latest regulator on the block is PFRDA, and they also have an insurance a PFRDA scheme for dealing with the subscribers issues relating to the national pension system and also the other pension system, which is Atal Pension Yojana. So all there is only one single ombudsman there. There is no data about how many complaints is handled. It is located in Delhi, and there is a mention of an electronic mechanism through which the complaint is supposed to be made, but I couldn't locate anything related to that. So in this context, the entire framework relating to ombudsman is spread. And if you see the institutions that are covered, not all institutions which are banks are covered in this scheme. Not all, because it is only the scheduled commercial banks, regional rural banks, payment banks, then small finance banks which are covered. So there are several banks like your rural cooperative banks which don't form within the system. There are 2 local area banks, though they don't form a part of the system. Unscheduled cooperative banks, where they are about 1,000 plus, they don't come into the picture. So the title is deceptive, the scope is limited, but a majority of complaints get redressed there. And being a direction, if there is, in spite of giving an award, if it is not complied with, the provision that has to be exercised is a provision which is violation of section 35A, which could lead to a penalty, which can go up to the cancellation of license of a bank. So the powers are not clear. They are all distributed across. The problem comes when cross-selling of products is also coming. So now a bank through its branch sells an insurance product or a mutual fund product and a mutual fund product, and it is providing investment advice based on which shares are being purchased by the customer or by the bank on behalf of the customer. So now if someone has a grievance relating to it, whom will he approach? He will go to the bank. Bank will say that I have paid the money to the insurer. He will go to the insurer. He will say that your bank has paid the money, so you will not be. So this, and if he goes to the mutual fund, then they will say SEBI, and you go on SCORES, and if you are not satisfied, go to the court. So there is an apparent perception that there is a consumer protection framework which is available, but it is to the extent that it is benefiting people, to the extent that their grievances are being redressed, it is okay. But I personally feel, but you go to the satisfaction survey also, RBI has done one recent survey and they have indicated 70% customers are satisfied. And their pool would be the customers who are aware of it. There are so many people who are not aware of it as well. And there are so many people who are disgruntled also, but they don't air it. So have a system which is going to be comprehensive, covering the entire financial system, and deal with all the grievances that are there in the system. Give them an opportunity to get a response at least. And second, give them an opportunity for getting their dispute redressed through conciliation.
Sorry to interrupt you, sir, in between. Mallikarjun, sir,
yes,
due to paucity your time, you should.
I will just wind it up. I am now going to talk about the last part of it. So this mediation, opportunity for mediation, and then finally an opportunity for an award where some compensation is going to be given. So this consolidated picture in relation to grievance redressal, the model that is available is the Financial Ombudsman Service, which is there in UK, and a similar service which is there in Australia. So we had a financial service sector legislative reforms commission yesterday. Sri Krishna sir was indicating that the financial dispute, the resolution corporation thing has not been done. They have also indicated that there should be a grievance financial redress agency, which is also another authority under the FSLRC. There was a committee which was set up by the government to examine this process. The committee gave its report in 2016 and it is languishing till 2020. So there is an urgent need for having a financial grievance redressal authority, basically to have a one-stop technically equipped shop where all the grievances relating to financial consumers are aired, acted upon by agents, and then finally a resolution of some sort will be given to them. first exhausting the conciliation mode, and then second exercising the award mode, and finally giving them an option whether to accept it or go for other mechanisms of redressal. In case the expertise that is available, which is pooled, will be enough in terms of providing a succor to person, and he doesn't have to run from pillar to post in order to get his grievance redressed. In case of UK, they have 360 ombudsmen of various capabilities who are handling these grievances. So we have only about 30 odd ombudsmen. The capacity that was handled there was close to 3 lakhs. And here, considering all the ombudsmen that we have handled only about 2 lakh complaints. And that too, most of them are non-maintainable complaints. So we urgently need a financial grievance redressal authority at a central level, and the government is supposed to be taking up this on a priority basis when they want to build financial inclusion and also want more participation into the insurance markets and also in the banking and financial system. Thank you.
Truly, it was an honor to have you, sir.
Thank you.
The entire presentation was highly commendable and informative for us.
Thank you. Thank you.
Now, the next presenter for the day, which we are having right now, is Dr. Vidhi Madan. Madam Vidhi is an assistant professor at Center for Postgraduate Legal Studies, Terry College of Advanced Studies. The presentation on which the madam will be speaking is, will Insolvency and Bankruptcy Code 2016 solve NBFC dilemma? Present challenges and way forward. Over to you, ma'am.
Thank you. Thank you so much, Mohit. Good morning, everyone. And I realize that we are just 2 minutes short of that good morning salutation. And it is indeed a pleasure to connect with my alma mater in these times. This is the ray of hope, and getting to see my professors is again something that makes me glad, and in these gloomy times. Thank you. The title of my presentation, as you've rightly pointed out, is on the NBFCs and its application, the application of the Insolvency and Bankruptcy Code, and the challenges it faces and the way forward. Now, this work which began when later last year, when we saw the application coming in terms of an amendment that was being proposed to the Insolvency Code. Now, in the present times, for the past 3-4 months, it has become a work in progress. Like the paper has become a work in progress, in the sense that we see changes coming every day, and the economic package that was announced by our Honorable Finance Minister is not exactly in tune with what the ordinance says. So let me just quickly take you to the 3 core pointers that I'll be taking up in this presentation in this short span of 6 to 7 minutes that have been given to me. The presentation secondly reviews what the circumstances which led to the application. Initially, the code excluded both as borrowers and lenders the NBFCs outside the purview of, or kept them outside the purview of the Insolvency and Bankruptcy Code, and it was only later. So I will look into those circumstances that led to the circumstances that made the code applicable to financial service providers, the broader term, and also covering the some kinds of non-banking financial companies under it. And I will just quickly take you through the new rules that came forward after that amendment, and what do they entail, critically appraising them, and finally highlighting the present challenges in the light of liquidity crunch that NBFC have faced even in the pre-COVID times. It is not some challenge that has, of course, it is mooted as it is the final nail in the coffin that the COVID times have brought, and giving some proposals in the present light of what rules do we have, what alternate mechanisms do we have, and also the ordinance which was brought about on 5th June. Reading all of them or collating all of them together, what can be the proposals in the present context for liquidity crunch that the NBFCs are facing. in the light of, I will not be touching upon the economic packages much of the RBI. I think there are a lot of presenters today who will be dealing with that. So I will just focus on the insolvency bankruptcy code and the alternate available. Now, beginning with, we know that the IBC ushered in the, the biggest reforms, the game changer that was mooted as for ease of doing business. And the impetus being of the code that it is a one-stop solution for consolidating all the, reconstruction or the insolvency laws for corporate persons, for partnerships, LLPs, and individuals. It is here, if you look at section 3, subsection 7 of the code, we realize that they have categorically left out FSPs, financial service providers, from the ambit of the legislation. And the initial, perplex situation was owing to the context that whether we read non-banking financial institutions under the ambit of financial service provider under the code or not, which was later clarified by a plethora of rulings by the National Company Law Tribunal and Appellate Tribunal, which are the adjudicating authority and appellate authority under the code, giving clear judgments, whereby, if I quote here, HDFC versus RHC Holdings, the NCLT order of 2018, or if I also quote the Ramdhiraj Thakur versus Jindal Saxena Financial Services as the NCLAT order of, again, late 2018, we realized that they've all categorically held these financial service providers as NBFC, and thereby not to be, put under the ambit of the IBC code. And they've categorically pointed out that they did not involve, these NBFC did not involve the public money, or they were not such any activity which was crucial to the economy, and hence they have to be kept outside the purview of the code. Then the reason for exclusion, which is rightly accepted also, that the FSPs are to be kept outside, was to avoid failure of the economy, which seems very probable if there is an increase in the influx of such failings happening and litigation mounting at the pretext of the code. Now, there were certain initiatives that were taken. That there was a proposal which began for the FRDI bill, which lapsed in 2017. Then, what were the actually situations? We saw that the last 2 years have not been very good for NBFCs. It all began with IL&FS, which later in 2018 came out with its crisis, and there was a felt need for resolution mechanism. And this due course also saw the alternate, which I'll be taking up in one of the proposals as well. We saw the February 12th notification, of circular of RBI pertaining to the prudential framework for dealing with stress assets, which was struck down in Dharani Sugar versus Union of India. I happened to attend the presentation given by one of the panelists also, I think Professor Kaval, who also pointed out that how NBFCs grappled through this phase of Dharani Sugar's case, and then came the final circular of June 7th of 2019, which is the present alternate mechanism available for revival of these non-banking financial companies. Now, in this backdrop, we saw that not only that mechanism, but there was a felt gap of resolution, because IBC takes any entity as not as the end, and also but as a going concern. It tries to restructure, and give them those alternate mechanisms. And then it was finally the case of DHFL, which again was struggling through the muddled resolution process. The lenders, were making innumerable efforts, and then came the RBI governor's statement as of providing them wider possibilities in terms of an amendment to be brought to the insolvency and bankruptcy code. Then we saw the exclusion of section 3 subsection 7 is still there. However, the mechanism has been brought out as a parallel to the existing CIRP regime, corporate insolvency resolution process scheme, under the insolvency bankruptcy code. It is proposed by adding an explanation under the section 227 of the insolvency bankruptcy code, whereby there is the power of central government to notify financial service providers, and thereby it says that there can be certain notifications and guidelines to provide for a mechanism of dealing with financial service providers. Then came the present rules that are in we'll be taking up, that are the insolvency and bankruptcy, insolvency and liquidation proceeding of financial service providers, and application of adjudicating authority rules 2019, which were made applicable to select financial. If I point out here, for NBFCs, they have been made applicable only to systematically important non-banking financial companies. They are those NBFCs which provide which have the assets worth of rupees 500 crore or more in the last audited balance sheet. And if we look at what these rules entail, we'll find out that the procedures which are laid down under these rules are a parallel to the CIRP process. The distinction lies in the filing itself. The normal CIRP can be invoked by a financial creditor or an operational creditor, whereas in this particular case, that is not the case. That is not what has been provided. It says that it can only be done by the appropriate regulator. Now, the appropriate regulator in case of SI-NBFCs is the RBI. So it is only on the pretext of on the initiation by the RBI that this CIRP can begin. However, the rest of the rules which pertain to the default, the amount of default, etc., remain the same as they are there in the existing section 7, 8, 9, 10 mechanism. Then the moratorium again is there as similar to the CIRP process. However, in addition to the moratorium, which is imposed upon the admission of non-FSP players, non-NBFC players, the interim moratorium also commences from the date of filing of the application until the admission or rejection of application itself, which is not there in the CIRP, normal CIRP process. Then, of course, they say that during this process of resolution of any NBFCs, the license or registration will not be suspended or cancelled, which was to give further impetus to these NBFCs to function as a going concern. And they don't fear that liquidity crunch. And instead of having the IRP resolution professionals who actually run the CIRP process, the parallel regime for NBFCs provides for administrators. And these administrators are to be then appointed by an expert group called as the advisory committee, which again takes directions from RBI. And they also mandate, over and above the existing time periods of getting the approval of the scheme from RBI within 45 days, adding to the already existing long drawn process. This no doubt, this regime was considered was a welcome step if you look into, because the outcomes led or enabled them to tackle with the situations of DHFL, and it was felt that this parallel regime provided alternatively to the prudential norms of June 7th, 2019 circular, in the form of filling the important gap which was left in the IBC code to cover NBFCs when they happen to be grappling with such situation. Now looking broadly into the core challenges that we face, we as I said, that the COVID-19 is the last nail in the coffin, and we've seen the past 2 years we've been hearing crisis, NBFC crisis, in terms of cash crunch, liquidity crisis, burgeoning bank loans, and we find out that most of the credit rating agencies says that they don't have on balance sheet liquidity, and how they have responded to the situation is that the impetus, the economic packages which are given by RBI, though NBFCs were made part of the second package which RBI gave. However, the announcement of the RBI package on moratorium provision, there has been a lack of clarity as to when NBFC is a borrower, not the lender. When NBFC is a borrower, whether this 3-month moratorium in respect of repayment obligation applies to them. You know, what happened? There have been numerous judicial pronouncements to this effect as well. If I quote here, April 9 decision of Delhi High Court, where in the India Bulls versus commercial, India Bulls commercial credit versus SIDBI, where the petitioner was an NBFC and he was claiming moratorium from SIDBI in the backdrop of this moratorium. It was clarified by SIDBI that there is no clarification given by RBI to this effect.
Really sorry to interrupt you.
Yeah, I'm just moving to the conclusions. The 3 proposals that I have. Yes, and when RBI, So since in the last month, even day before yesterday, we saw SIDBI's package coming that it will give offer moratorium to NBFCs when and only when the loans are structured and offered to MSMEs, and similar notifications have come from PNB and SBI. So there is no structured policy that has been adopted to induce that liquidity in terms of NBFC when they're blocked balance sheets and they don't have something to be offered. And then, of course, second challenge has been the vagueness of the ordinance that came out on June 5th. The ordinance fails to cover. I look that there's another presenter on IBC. Maybe that person takes you through like bit by bit of June 5th ordinance. But to point out here that they have by use of terms like ever, such time period, ever default, in the sense that they have actually the expectancy was a blanket ban, which they have not given. They say that only the defaults which start from 25th March to 6 months, where also the dates of notification have not been so far came out. It again I feel is mounting litigation before the NCLT adjudicating authority, looking for these gaps to be filled. Now, my 3 core proposals being the one, I begin with what Moody's, one of the credit rating agencies, said in case of DHFL. It said that DFHL, in case of DFHL, RBI initiated the resolution process only when by suspending the DFHL board because of corporate governance issues. So this is the right time where RBI looks into if this resolution can happen by or is the cause is the weak corporate governance which deters them, or this is how if they could lead to resolution process, not going into actual process or rigors of IBC. Means a selective approach to IBC can be taken by RBI in these times of vagueness of the ordinance until the time the clarity comes out to us. And secondly, we also saw that if this time period of 1 year is there, 6 months to 1 year is there, that any insolvency can be brought about. So then also some lenders can resort to the prudential framework, the alternate framework that is present in these times, because there is no clarity as to the default which they take up, whether it is a continuing defaults or if some default happened prior to 25th March, which amounted to say 65 lakhs, and something which continued after that of 35 lakhs. So that can be one of the situation. And lastly, I also feel this is the time when NBFCs can also look into the adoption of certain bilateral negotiations and adopting measures with borrowers for prudent settlement rather than raising disputes amongst these circumstances in the light of ample time that has been given to them in the moratorium period for prudential norms for 3 months and 6 months. I think this is the time they can utilize to settle through these negotiations and not resorting to IBC. So this is from, these are the proposals from my side in the present context of these offers available of economic package, and as well as the ordinance that has came out till the time clarity is brought about. Thank you so much. And again, I thank, I see AP Singh sir here. Thank you so much, sir. Virtually connecting with you and a number of teachers, as I told that, in these gloomy times, this has brought that smile on my face. Thank you, Dr. Zubair. Thank you so much. I look forward to such interactions.
Thank
Yes.
you, Vidhi.
Yes.
As it was a highly informative session related to issues and weighing suggestions with respect to the subject matter of NBCs. Thanks for having me here, ma'am. I would like to relate the fact that due to paucity of time, we are only having 6 to 7 minutes per presentation. So all the participants are requested to discuss only the core issues and the weighing suggestions and their concluding observations. The next presentation will be of Mr. Ritanjal Ghosh and Dr. Kalpita Ray. They are from Punjab National Bank, Assam. And the topic for their presentation is economic imbalances during COVID-19 scenario and role of banks. Over to you, sir.
Thank you very much for your kind just introduction. And good morning, everybody, especially good morning, Dean Sir, and all the fellow attendees, participants of this webinar. And I just want to go through my presentation at the earliest. And yeah. So my topic is economic imbalances during COVID-19 scenario and the role of banking system. Just to brief out as with a small introduction, that when there is an economic imbalance, there is a situation of economic disequilibrium where aggregate demand is not equal to aggregate supply. And as an effect, the national income is also affected since the income does not equals to the consumption function, investment function, government expenditure, and net exports. And it is now known all of us to that Government of India augments Y through enforcement of fiscal policies, and it is well balanced by Reserve Bank of India, who is vested with the responsibility to conduct monetary policies under the RBI Act 1934. Now, the objective of our research is to investigate the challenges faced by the Indian banking industry pertaining to catering financial services to next billions, scrutiny of human resource related to issues, especially in public sector banks, and also to vindicate the role of Indian banks in supplementing Indian economy along with the government policies during 3 stages, that is in the pre-COVID, during the lockdown, and in the post-lockdown scenario. Now, this is a simple circular flow of all the elements which I have discussed earlier, wherein we see that in a balanced economy, we have Y as equals to C plus I plus G and NX. Where NX is the net export, that is export minus imports, what is the earning we generate from it. Now, when there is a situation of economic distress, when aggregate demand does not equals to aggregate supply, consumption function tends to fall. Also, there is fall in investment as savings equals investment, and with limited trading activities, net exports also tends to generate minimal yield. In this situation, Y can only be boosted through suitable fiscal policies. And it's a matter of fact that these fiscal policies are also prudently complemented by a set of monetary policies through the RBI. And it is known to us that fiscal policies and monetary policies are the 2 exclusive tools which are maneuvered by the government of a nation to achieve its macroeconomic objectives. Now, in the situation of economic imbalance, a high growth of GDP is anticipated, for which we require fiscal stimulus, policy stimulus, and this in turn increases demand for goods and services. This is again complemented by catering of cheaper credit facilities from banks along with proportionate rate cuts adopted by RBI. Now, to just briefly go through the functions of RBI and its special roles during economic imbalances, we see that RBI is a banker's bank. It helps in credit management. It also helps in controlling exchange rate and currency management. It is the sole note issuing agency. It's a banker to the government, and it is also the lender of the last resort. And in special measures, we have seen that there has been a numerous rate cuts, especially in CRR, SLR. Repo, reverse repo rate has been slashed. There has been also provision of moratorium for payment of term loan installments. There has been deferment of interest of working capital loan, refinance facility for NABARD, SIDBI, National Housing Board to the extent of 50,000 crores, and also allotting money so as to increase in ways and means and advance for centers and states. Now, bank has been declared as an essential sector, especially in the time of economic imbalances. And apart from performing its regular functions, bank has been also involved in a series of functions, such as execution of all the RBI's policies, the rate cuts, and passing out to the customers. It has also engaged in rolling out different type of government schemes, especially PM Kisan Nidhi and all sections and all schemes benefiting the rural and the poorer sections. Also, it is encouraging digital banking services since it has been an undrawn blood in our economy. It has also helps in providing financial inclusion through financial literacy. It has also provisioned doorstep banking, especially in this time of pandemic, to pensioners and all the senior citizens. It has also helped in lending new COVID-linked loans as personal loans or loans to SHG or JLG members, also to farmers under the PM Kisan Nidhi beneficiary. There has been also waiver of charges in the debit cards, in the net bankings. There has been also waiver of minimum balance charges for maintaining amount in the saving balance account, especially in the rural branches, and also operating procedure from PMJDY and PMJKY. This has been initiated in this pandemic situation, where the last digit of the accounts of the customers have been proportioned in which day they shall go in the bank to collect their money. And finally, restructuring of all MSME loans and also moratorium of loans. Now, the twin challenges for the Indian banking industry is, first of all, we discuss about the next billions. Now, these next billions are basically those segment of people who are holding an annual income of around 60,000 to 1,80,000, and they're actually in the bottom of the pyramid of the financial services, where they are mainly devoured or they're yet not being captured. And in this state of things, not only state subsidies, we require proper infrastructure, like through the capturing of CKYC through UIDI methods, and at a very low cost of capturing KYC compliance. Further, there should be also lending supports through SHG and JLG, also enhancing online BC or CSP models to enable real-time transaction cost, which should be very minimal to them. And finally, offering them insurance packages, remittance, and all the know-how of the financial literacy, all under one single window or umbrella. And the second issue, which is pertinent to our public sector banks, is the management of human resources. Now, public sector banks have been basically following all conventional HR measures, and definitely non-adherence of these HR issues won't fructify us to capture these next billions. There also exists issue of demographic risk pertaining to retiring of old officers, experienced officers, and recruitment of new generation bankers. Now, not only we need inducting of talent among these fresh recruits to retain our competitiveness in market, we also need to contain our average cost per employee in public sector banks, which has exceeded since the past decade. And finally, pioneering of new learning skills, especially soft skills or digital banking know-how, is the need of the hour, as we need to unlearn some of the long-standing old practices. And finally, for my last slide, what has been the role of the banks in the different situation of the economy along with the government measures? Here I've just summarized some few points in three basic situations, where in the pre-COVID situation, our economy was distressed due to impact of demonetization, improper GST application, rise in gross NPAs of banks, followed by corporate rate tax cut, but it has failed to generate sufficient demand, and as a result, consumption expenditure has been also low with low investment. There was also lack of fresh investment due to frauds in banks, and also due to default of loans by IL and FS. In terms of monetary policy, Reserve Bank has always balanced to all the fiscal policies where they have slashed the desirable rate. They have done one structuring of MSME accounts. Due to the green situation of the shadow banking and the rate cuts, there has been not much consumption expenditure or new investment. Further, there has been the implement of counter-cyclical buffer and also revision of housing loan limit under parity sector to RRBs and small sector banks. Now, in the lockdown period, there has been announcement initially of 1.07 lakh, followed by a package of rupees 20 lakh crore, approximately of our GDP under the Atmanirbhar Bharat Abhiyan. Further, there has been extension of deadlines for filling of tax, GST, and other important returns. There has been also the introduction of Arogya Setu app, and rise in employment of NREGA workers